Welcome back to Audit Insights. Today, we're tackling a topic that keeps auditors vigilant: fraud. Specifically, we're diving into International Standard on Auditing, ISA 240, the auditor's responsibilities relating to fraud in an audit of financial statements. It's about knowing what to look for and how to react. First, let's define fraud. ISA 240 clarifies that fraud is an intentional act involving deception to gain an unjust advantage. This distinguishes it from error, which is unintentional. Fraud can be perpetrated by anyone, from top management to ordinary employees, or even third parties. ISA 240 focuses on two primary types of fraud that result in a material misstatement in the financial statements. 1. Fraudulent financial reporting. This involves intentional misstatements or omissions of amounts or disclosures in financial statements to deceive users. Think about manipulating revenues, accelerating revenue recognition, or concealing liabilities. Management is often involved here. 2. Misappropriation of assets. This involves the theft of an entity's assets. Examples include stealing cash, inventory, or manipulating expenses for personal gain. This type of fraud is often committed by employees. It's crucial to understand the auditor's responsibility. The auditor's objective is to obtain reasonable assurance that the financial statements as a whole are free from material misstatement, whether caused by fraud or error. This does not mean the auditor is responsible for detecting all fraud. Due to the inherent limitations of an audit, there's always an unavoidable risk that some material misstatements due to fraud may not be detected, especially if there's collusion or sophisticated concealment. The standard emphasizes professional skepticism throughout the audit. Auditors must maintain a questioning mind and critically assess audit evidence, never assuming management or those charged with governance are dishonest, nor assuming unquestioned honesty. So, how do auditors address fraud? It starts with robust risk assessment procedures. The audit team is required to 1. Hold a discussion. The engagement team must have a discussion about the susceptibility of the entity's financial statements to material misstatement due to fraud. This is often called a brainstorming session, to share insights and consider where fraud might occur. 2. Make inquiries. Inquire of management, internal audit, and those charged with governance about their assessment of fraud risks, and any known or suspected instances of fraud. 3. Perform analytical procedures. At the planning stage, these can identify unusual relationships or trends that might indicate fraud. 4. Consider fraud risk factors. Evaluate whether any conditions or events, known as fraud risk factors, are present. These include incentives, pressures, opportunities, and attitudes, rationalization. Once fraud risks are assessed, the auditor must develop appropriate responses. 1. Overall responses. This might involve assigning more experienced staff, increasing the level of professional skepticism, or incorporating elements of unpredictability into audit procedures. 2. Responses at the assertion level. Design specific audit procedures to address the identified risks. For example, if there's a risk of overstated revenue, procedures might focus on revenue cutoff testing, or substantive analytical procedures that include independent data. 3. Responses to management override of controls. This is a significant risk in almost all audits. Auditors must always perform specific procedures to address the risk of management overriding controls, such as testing journal entries and other adjustments for evidence of bias. Reviewing accounting estimates for biases. Evaluating the business rationale for significant unusual transactions. What happens if the auditor identifies or suspects fraud? ISA 240 provides clear guidance. 1. Communicate the matter to the appropriate level of management. If management is involved, communicate to those charged with governance. 2. Evaluate implications. Assess the impact on other areas of the audit and the reliability of prior audit evidence. 3. Consider auditor's report. Determine the implications for the auditor's report, especially if the fraud results in a material misstatement that is not corrected. 4. Legal, regulatory duty. The auditor also has a duty to consider if there is a legal or regulatory requirement to report the matter to an outside party. In essence, ISA 240 reminds us that while management has primary responsibility for preventing and detecting fraud, auditors play a vital role. By maintaining professional skepticism, performing thorough risk assessments, designing appropriate responses, and properly documenting our findings, we contribute significantly to the integrity and reliability of financial reporting. Thanks for watching. Don't forget to like and subscribe for more insights into auditing standards.